To understand how to open a position and how to make money in the forex market, we have used an example of a trade on the euro-dollar exchange for an amount of $11,000. But it's unlikely that you'd really want to invest that amount of money, especially because you are at the very beginning of your trading career and you wouldn't feel confident risking $1,000 in a single trade, let alone $11,000. It's also possible that you don't have that much capital to invest just yet either. So you can use something called leverage. Leverage is basically the ability to control large amounts of capital using very little of your own capital. But before getting into the detail of it, we will need to talk about balance, equity, and margin. Balance is the amount of money you have in your trading account without taking into consideration your open trades. Equity is the amount of money you have in your trading account, including any unrealized profit or loss deriving from your open trades. Let's say that you have $10,000 in your account and an open trade on euro-dollar at a rate of 1.2 for an amount of 0.01 lots, which is giving you a current loss of $100. In this case, your balance is $10,000, while your equity is $9,900. So your equity is simply the balance plus any current profit or loss deriving from trades you still have on the market. Having clarified these terms, we can introduce the concept of margin. The margin is a sum of money that you have to guarantee to your broker in order to open your trade. In this example, we have bought 0.01 lot of euro-dollar at 1.2. How much money are you using for this position? We know that 0.01 lot is 1,000 units of the base currency, so 1,000 euros in this case. At the exchange rate of 1.2, 1,000 euros is $1,200. So for this investment, you are using $1,200 of your account. This is the margin you need in order to open this trade. So essentially, you need to guarantee to your broker that in case your trade doesn't go well, you have $1,200 to pay them. So you are using a margin of $1,200. What is the remaining margin that you can use if you want to open other trades? The free margin is defined as equity minus margin used. In this example, we have an equity of $9,900 and a margin used of $1,200. So your free margin is $8,700. On the MetaTrader 4, the platform we will be using later on in this course, we have this information at the bottom: balance, equity, margin, free margin, and margin level. Just to repeat again, balance is the amount of money you have in your trading account without taking into consideration your open trades. Equity is the amount of money you have in your trading account, including any unrealized profit or loss deriving from your open trades. The margin is a sum of money that you have to guarantee to your broker in order to open your trade. The free margin is the remaining margin that you can use if you want to open other trades. Margin level expresses the ratio between the equity and the margin used in terms of percentage. What happens if your free margin goes to zero? First of all, you will not be able to open any new trade. Then, if your current trades lose more money, your free margin can become negative. In this case, the broker will give you what is known as a margin call. So they may request you deposit more funds, or they will close some of your trades, so your free margin will become positive again. Let's have the same example on euro-dollar, but this time we have $2,000 in our trading account and we are losing $900 with our trade. In this case, we have a balance of $2,000, an equity of $1,100, margin used is $1,200, and the free margin is minus $100. With a negative free margin, your broker may ask you to deposit at least $100 to restore the free margin, or it will close your trade on euro-dollar. In case your broker gives you a margin call, closing your position, you will lose $900, which is the loss you were having on your euro-dollar trades, and you will be left with $1,100 in your account. Now it's time to introduce the concepts of leverage. Leverage is the use of borrowed funds to open your trades. In this example, we opened a trade buying 0.01 lots of euro-dollar at a rate of 1.2, which cost us $1,200. With a leverage of 100 to 1, for example, we could still open the same investment, putting only $12 of our own money, while the broker puts in the rest, which is $1,188. Now, this usually leads to many misconceptions about the risk of using leverage. Are we risking more? Do we owe any money to the broker in case we lose the money they lent us? And many other questions like this. So we will suggest looking at the leverage as an instrument that allows you to decrease the margin used to open your trades. On the left side, we have the previous trade on euro-dollar without using the leverage. On the right side, we have the same trade on euro-dollar using a leverage of 100 to 1. As you can see, balance and equity are exactly the same, but what about margin used and free margin? In the first example, we are buying 0.01 lots of euro-dollar for a total of $1,200 without any leverage, so we need to use a margin of $1,200. Our free margin is $8,700. In the second example, we are buying exactly the same amount of lots of euro-dollar, this time using a leverage of 100 to 1, which allows us to use only 1 cent of the margin, so $12. In this case, the free margin is $9,888. Now, these two positions are exactly the same in terms of risk and potential reward. If euro-dollar goes up by 100 pips, we make $10 in profit, either with or without leverage. It's the same if euro-dollar goes down by 100 pips, we lose $10 in both cases. So what changes? Using the leverage allows you to use less margin per trade, leaving you with a higher free margin that you can use if you want to open other trades. This could lead you to open too many trades or invest larger amounts just because you have more margin available. But if you don't overtrade and you manage your account properly, the results of trading with leverage or without leverage are the same. So, in summary, margin is the amount of money you have to guarantee to your broker in order to open your trades. Leverage is an instrument that allows you to use less margin when you open your positions and has no effect on the risk and the return of your trades. Risk and return of your trades are determined by the lot size you set, combined with the stop loss and the take profit if you have any. I know all these concepts may be overwhelming at the very beginning. In the next section, we're going to open our first account with a forex broker so we can have some practical examples and see how these concepts work during real market trading activity. For now, feel free to run through this entire section again if you like, because these concepts are very important to understand. And if you have any question, feel free to use the question and answer section. I'll be more than happy to help you progress in your path to becoming a successful trader.